In 2022, Disney's streaming business was adding millions of subscribers, yet losing billions of dollars at the same time, exposing a model that was growing in size but breaking in economics. The company reported over $4 billion in streaming losses in a single year, despite rapidly expanding its global audience. This contradiction revealed a deeper issue. Growth was no longer translating into profitability. Disney Plus had reached over 150 million subscribers, but each additional user was adding pressure instead of stability. The strategy required massive content spending to compete, locking the company into continuously rising costs. At the same time, traditional revenue from cable television was declining, removing a major source of profit. Disney was now funding an unprofitable future, while its profitable past was shrinking. Investors began questioning whether scale alone could ever make the streaming model sustainable. What looked like rapid success on the surface was actually a system where growth was amplifying losses instead of solving them. The pressure became visible in late 2022 when Disney reported quarterly results showing streaming losses exceeding $1.5 billion in just 3 months. This was not an isolated issue, but part of a larger trend where losses were accelerating as the platform scaled. Disney Plus continued to add subscribers, but the cost of acquiring and retaining those users was rising even faster. The company was spending heavily on original content, licensing, and global expansion to compete in an increasingly crowded market. At the same time, revenue per user remained relatively low compared to the cost required to serve them. This created a situation where growth was increasing operational strain instead of improving financial performance. Investors reacted sharply as the expectation of future profitability began to weaken. The stock came under pressure as the gap between subscriber growth and actual earnings became more visible. What initially appeared as strong momentum began to reveal a system where scale alone could not guarantee success. Disney's streaming strategy was built on a simple but aggressive idea: scale first, profit later, with the expectation that a large subscriber base would eventually turn into a sustainable business. The company launched Disney Plus in 2019 and rapidly expanded using some of the most powerful content libraries in the industry, including Marvel, Star Wars, and Pixar. Subscriber growth accelerated quickly, reaching over 150 million users within just a few years, far faster than Netflix had achieved at a similar stage. This rapid expansion created the impression that Disney had successfully entered and disrupted the streaming market. However, the model required continuous content production to keep users engaged and prevent churn. Each new series or movie came with high production costs, often running into hundreds of millions of dollars. Unlike traditional box office releases, streaming content generated limited direct revenue per viewer. This meant that increasing scale did not immediately translate into higher profitability. The system was growing exactly as planned, but the financial structure behind it was becoming increasingly strained. As Disney scaled its streaming platforms, the cost structure began expanding at a pace that was difficult to control. By 2022, total content spending across Disney's media operations had risen to over $30 billion annually. A large portion of this spending was directed toward Disney Plus, Hulu, and ESPN Plus, all competing for attention in the same market. Each new release was not just content, but a necessary investment to keep subscribers from leaving. The model depended on constant engagement, which required a steady flow of expensive productions. At the same time, subscription prices were kept relatively low to maintain growth, limiting revenue per user. This created a gap where costs were rising faster than the income generated from each subscriber. The more the platform expanded, the more it needed to spend just to sustain its position. What appeared to be growth was increasingly becoming a cycle of rising costs with limited financial return. At the same time that streaming costs were rising, Disney's traditional television business began losing strength. Cable networks, which had generated stable and high-margin revenue for years, started facing declining subscriber numbers. Millions of households were canceling cable subscriptions, reducing one of Disney's most reliable sources of profit. Advertising revenue linked to television also began weakening as viewership shifted toward digital platforms. This shift removed the financial support that had historically funded content creation and expansion. The company was now transitioning from a profitable legacy model to an unprofitable future model at the same time. Instead of one system replacing another smoothly, both were under pressure simultaneously. Streaming required heavy investment, while television could no longer generate the same level of returns. This overlap created a structural imbalance that increased financial strain across the entire business. As losses continued to expand, Disney began adjusting its pricing strategy in an attempt to improve revenue without slowing growth. Subscription prices were increased across multiple markets, and new tiers were introduced, including ad-supported options. These changes aimed to raise revenue per user, but also introduced the risk of higher cancellation rates. At the same time, the company faced pressure to reduce spending without weakening its content pipeline. Balancing cost control with competitive output became increasingly difficult as rivals continued investing heavily. Investors began questioning whether the strategy of prioritizing scale over profitability could still work. The market response reflected this uncertainty, with Disney's valuation coming under sustained pressure. Management was now forced to reconsider the pace of expansion and the structure of its investments. What had started as a growth-focused strategy was turning into a challenge of managing losses while maintaining relevance. By late 2022 and into 2023, the financial impact of the streaming strategy became fully visible across Disney's overall performance. Streaming losses exceeded $4 billion annually, while operating margins across the company continued to decline. The stock came under sustained pressure as investors began pricing in a longer path to profitability. At the same time, leadership changes reflected growing urgency, with strategic direction being reassessed at the highest level. Cost-cutting measures were introduced, including layoffs, and a renewed focus on efficiency across divisions. Content spending was reviewed more critically, with an emphasis on return rather than volume. The company began shifting from aggressive expansion to disciplined execution. This transition marked a clear change in how Disney approached its streaming ambitions. What had once been a race for scale had now become a challenge of restoring financial balance. By 2023, Disney began restructuring its streaming strategy, shifting focus from rapid expansion to long-term profitability. Subscription pricing was adjusted again, and ad-supported tiers became a central part of the revenue model. At the same time, the company reduced content spending, prioritizing fewer but higher-impact releases. These changes were designed to improve margins without losing too many subscribers in the process. The business began stabilizing, but the original assumption of scale-driven profitability no longer held in the same way. Streaming could still grow, but it required a different balance between cost, pricing, and content. Disney was no longer chasing growth at any cost. It was trying to rebuild efficiency into the system. The transition highlighted how difficult it is to replace a profitable legacy model with a new one under pressure. The case showed that even the strongest brands can struggle when growth increases scale but fails to improve profitability.